What if I told you that the secret to really successful investing has way less to do with complicated math and spreadsheets and everything to do with mastering your own mind? Well, for decades, one single book has been the go-to guide for that exact idea. Today, we're going to dive into its timeless wisdom and break it down into a framework you can actually use. Let's get right into it. It's a great question, right? And to answer it, we have to look at the pretty shocking story of one of the greatest minds in all of human history. We're talking about a man who literally wrote the laws of the universe, but even he got totally swept up in the madness of the crowd. You heard that right. Sir Isaac Newton. Back in the early 1720s, he got into the South Sea Company, which was like the hot tech stock of its day. He made a quick buck, doubled his money, and got out. Smart, right? But then, he had to sit there and watch his friends get ridiculously rich as the stock just kept soaring. The FOMO, the fear of missing out, it just ate him alive. This is the man who discovered gravity, but he let his emotions completely defy logic. He jumped back in with everything he had right at the very peak, and when that bubble inevitably burst, he lost it all. Newton's story is the perfect example of a huge problem. Market craziness can make a fool out of anyone, even a certified genius. So, what's the solution? It's this book, Benjamin Graham's classic, The Intelligent Investor. And when Warren Buffett calls it by far the best book on investing ever written, it's because it gives you the mental armor to fight the very emotions that brought Newton down. Okay, so Graham's first lesson, and honestly, this is the most important one, is that you have to know what game you are playing. Are you an investor or are you a speculator? Because trust me, the rules, the mindset, and the outcomes are from two totally different planets. Graham's definition of what a real investment is, it's so simple, but it's incredibly powerful. It really comes down to three things. First, you have to do your homework, thorough analysis of the actual business. Second, it has to promise safety for your original money, your principal. And third, it promises an adequate return. Notice he didn't say spectacular or mind-blowing, just adequate. If what you're doing doesn't tick all three of those boxes, then by definition, it's not investing, it's speculating. And you can really see the difference here. The investor, they think like a business owner. They care about the company's real value. So for an investor, a big price drop is great news. It's a chance to buy more, like their favorite store is having a sale. But the speculator, they're just a gambler, and they are obsessed with one thing, the price on the screen. A price drop is terrifying because they're just betting it'll go up so they can flip it to someone else. So you have to ask yourself, are you buying a piece of a business, or are you just buying a stock ticker hoping it goes up? This obsession with price leads us perfectly into Graham's next genius idea. To help us deal with the market's absolutely wild and irrational mood swings, Graham gives us this incredible mental model. He wants us to imagine we have a business partner. And this partner, he's a little emotional. His name is Mr. Market. So just picture it. You own a small piece of a private company. You're in it for the long haul. You care about how the business is actually doing, making sales, turning a profit. Now, your partner, Mr. Market, he shows up every single day, and he's always shouting a price in your face, a price where he'll either buy you out completely or sell you his share of the business. But here's the thing about Mr. Market. He is a complete manic depressive. Some days, he is totally euphoric. He's convinced the future is nothing but rainbows and sunshine, and he'll offer you a ridiculously high price for your shares. But on other days, he's in total despair, certain the world is about to end, and he'll offer to sell you his shares for practically nothing. His price has zero connection to the actual value of the business you own together. It's all just raw, unfiltered emotion. So, how in the world do you deal with a partner like that? Well, the intelligent investor knows exactly what to do. You use him. First, you need to realize you are free to completely ignore him. His daily price quotes are there for your convenience, not his. You never ever let his panic become your panic. Instead, you do the opposite. You buy from him when he's freaking out and selling everything at a huge discount. And you might consider selling to him when he's giddy and offering you a crazy price. You are in the driver's seat, not him. Okay, so how do we protect ourselves from Mr. Market's craziness? And let's be honest, from our own mistakes? Graham gives us one powerful concept that is the bedrock of his entire philosophy. He calls it the margin of safety. It sounds complicated, but it's actually pretty simple. The margin of safety is just the discount you get when you buy something. It's the gap between what a company is actually worth, its intrinsic value, and the price you pay for its stock. You figure out that value by looking at its earnings, its assets, its future prospects. The wider that gap is between your conservative estimate of its value and Mr. Market's crazy price tag, the more room you have for error. It's your buffer. It's your financial shock absorber. And I love this quote because it makes the whole idea so practical. Investing shouldn't be like buying perfume, where it's all about emotion and feeling fancy, and a high price can actually make it seem more desirable. No, it should be like buying groceries, a totally rational process where you're just looking for quality stuff at a good price. You're hunting for a bargain. Buffett just nails it with this simple example. Think about it. Which is riskier, buying a dollar for 60 cents or buying that same dollar for 40 cents? Obviously, paying 60 cents is riskier. So, a bigger margin of safety, getting that dollar for just 40 cents, it does two incredible things at once. It lowers your risk and it increases your potential reward. That is the most powerful 1-2 punch in all of investing. So, after Graham teaches us how to think like an investor, how to deal with Mr. Market, and how to protect ourselves with a margin of safety, he leaves us with his final and most profound lesson. And it's all about where the real fight takes place. And this is the whole thing right here. After all the research is done, the biggest threat to your financial success isn't a stock market crash. It's not a bad economy. It's you. It's the person in the mirror. Just like Sir Isaac Newton, every single one of us is hardwired for fear, for greed, and for following the herd. The ultimate challenge isn't beating the market, it's conquering yourself. And that's actually where all the power lies. See, you can't control what the market does tomorrow, but you absolutely control your own behavior. You control your discipline to stick to your plan, you control your patience to wait for a great opportunity, and you control your emotions when Mr. Market is having one of his tantrums. Your financial destiny is in your hands, not his. So I'll just leave you with this one last thought straight from Graham's timeless wisdom. Is it possible that your biggest financial risk isn't out there in the market, but it's actually looking right back at you in the mirror? Really thinking about that question? Well, that just might be the first real step to becoming an intelligent investor.